What do P&L statements reveal about hidden restaurant costs? Imagine looking at a restaurant's financial report and discovering costs you never knew were eating into your profits. That is what a profit and loss statement can do. It breaks down all the money coming in and going out, but it also shows hidden expenses that can sneak up on you. These hidden costs can be food waste, extra labor expenses, or rising utility bills that are not obvious at first glance. The cost of goods sold, which includes ingredients and supplies used to prepare dishes, is a big part of what P&L statements reveal. If this number is high or keeps increasing, it might mean food is being wasted, ingredients are spoiled, or portions are too large. For example, if a restaurant buys fresh vegetables but throws out a quarter of them because they spoil before use, that adds to the cost of goods sold without generating revenue. Tracking inventory and comparing it to sales helps spot these inefficiencies. It also shows if menu prices are enough to cover actual ingredient costs, which is vital for staying profitable. Labor costs are another area that can hide extra expenses. Besides wages, the P&L statement includes payroll taxes, employee benefits, and overtime pay. Sometimes, staff schedules are not optimized, leading to unnecessary overtime costs. If a restaurant pays staff time and a half for overtime but does not monitor it, those costs can add up quickly. Misclassifying employees can also cause tax issues and extra expenses. Keeping a close eye on labor as a percentage of sales helps manage staffing better and avoid overspending. Operating expenses like rent, insurance, and utilities are also shown in these statements. Sometimes utility bills spike unexpectedly because of inefficient kitchen equipment or excess food storage. For instance, if a walk-in freezer runs longer than needed, or if lights are left on in unused areas, costs increase without anyone noticing right away. Regular reviews of these expenses can catch unusual trends early. Payroll mistakes can also be hidden costs. Paying employees overtime unnecessarily or misclassifying staff can inflate labor costs and lead to penalties. These errors might not be obvious unless you review your payroll reports carefully. Inventory management and portion control are key areas where hidden costs hide. Without proper controls, restaurants might buy too much inventory or serve larger portions than needed, which increases food costs and waste. Using recipe costing and inventory tracking tools can help identify these issues. Restaurant owners can use P&L statements to make smarter decisions. For example, adjusting recipes to match actual costs, monitoring stock levels to reduce spoilage, scheduling staff more efficiently, and auditing payroll regularly. Keeping a close eye on utility bills can also reveal unexpected increases that need addressing. By analyzing each part of the P&L statement carefully, restaurant businesses can uncover costs that quietly chip away at profits. Addressing these hidden expenses helps improve financial health and keeps the business sustainable in a competitive food industry.